Property Podcast. I'm Simon.
And I'm Simon.
I've been investing in property for over 20 years, and if you're an active landlord or planning your next property investment, this podcast is for you. And today I am joined by Simon Glastonbury, who is an independent mortgage broker with 25 years of experience providing mortgages, bridging, and development finance for home buyers and investors. Now, we quite often kick off these episodes around the Bank of England base rate and how that's changed or how it might change in the future and sort of the effects that can have on the market as a whole. And the most recent change was a bit of a non-event. So, what did or didn't happen, Simon, and what does this mean?
Yeah, so we're sort of setting ourselves up for these, Simon, aren't we? Because we're expecting great things and being let down again. I suppose the good news is 3 of the committee voted that there was a drop, so that sort of gives us hopefully an indication of what will happen going forward, because that's generally the case. But base rate stayed where it is, 425. So, which is, I think, for the borrower is a little disappointing for us all, isn't it? Really, and we were expecting it to be at 4. We wanted it to be lower than 4. It isn't. I think we probably got that for the summer now. Can we hope it will happen in July? Yeah, possibly. I'm not getting too excited about it now, unfortunately. I think we are. I think this is the burning question which we get every single day, as you can imagine, from clients. What's going to happen? Is it the right time to fix? Is it going to come down? When it does, if and when it does come down, are banks following? The simple answer to that at the moment is they don't really seem to be following. They're playing around with the very lowest of fixed rates, around about the 4% mark, just a little bit lower. They are dipping below the 4% mark on occasions, and they've been doing that for some months now. Is it really changing very much? No, it's not. Is it the right time to fix in? I'd certainly say yes, it is. It's unlikely we've all got to be very lucky if we hit the bottom of the market. We know that. Hopefully we do. I think we certainly are where we are for a period of time. So if you're getting rates that are very, and I think we've said it before, historically, if you can get funding at 4%, it's very, very good. Forget the days of 1.2, 1.1. They're not coming back anytime soon. So this is where we are. You look at swap rates going over the 2, 3, 5 year period. Banks have built these rates in. They built the costs in. If you can get money at 4%, I think that's a good figure to be looking at, and work everything out on that basis.
Yep, indeed. Long gone are those very, very attractive, very, very low rates. But at least it looks like we're going to have a little bit of period of stability. So that's good. And do hang around for the end of the episode, where we will give our normal rates roundup of what is actually currently available on the mortgage market. And before that, we will mention a little bit around ideas for helping your own children with university accommodation and what a property investor's view might be on that. However, before all of that, we are going to talk a little bit about a survey or an article that we've seen in the news recently, which was saying that only 29% of brokers, and by that I think it means mortgage brokers, trust current agent valuations. This was sort of their sort of, I don't think that was actually the headline, but that was one of the key points. So, Simon, are you in the 29% who trust the agent valuations, or are you in the majority who thinks they're a little bit suspect at the moment?
I like the high voice. I think I'm a little bit suspect, should we say? It goes to agent to agent. I think if we the article is really good because it highlights certain things. what it does highlight is that estate agents are like you and I. Um, there is no specific training they go in to start valuing properties. They don't have a magic calculator. They don't have a little box in the back of the office that says just for estate agents valuations only. Um, they have the same tools as we do, particularly these days, because everything's online. You
Hmm.
can see as much information as you want. You can see if you just take your average street. Not sure if there's an average street these days, but you can kind of see where I'm going. Everybody kind of knows one in their area. You get a very good idea very quickly by 2 minutes of research on the internet as to what properties have been sold for, what they're being valued at the moment, how long the properties have been on the market, and everybody knows. You generally realise if someone's property has been in your road and it's been on the market for a long period of time, then generally it's overpriced. It's simple as that. It will sell. Now, don't be wrong, the market is very, very slow at the moment. We're seeing that. So it is a little bit skewed. Um, but from going back to the article, unfortunately, there are many estate agents out there at the moment who are crying out for business. The market's slow. When you're crying out for
Hmm.
business, they will do all sorts of little, let's say, tricks of the trade to try and get your business. Now, classic trick of the trade is to upsell. So they'll say your property is worth 300 when it's only really worth, they know they're only going to get 275 for it because they want it on their books. When they want it on their books, they'll
Yeah,
then
yeah.
say, "Oh no, it's really overpriced. I've got someone who'll get it at 275, 280 for you." But and then you're in there then. No,
Mm.
I totally understand where they're coming from. I get they've got a business to do, to work with. They've got staff like everybody else. It's not illegal. Morally, is it okay? Everybody's got their own idea of that. The problem we then have, it does sort of then create an issue further down the line, because then someone will come in for that property and say, "Oh yeah, well, I will actually buy that for 300,000." Being an investor, being in someone who wants to buy it as a residential, they then come in and an outside valuer, independent valuer, comes in from the lender, and they said, "No, this is worth 275 tops." So we then say,
Mm.
they're looking at us, the client's looking at us and saying, "Well, what do you mean? I want to pay 300 for it." Well, yeah, you can, but you've got to find the additional deposit to put down. You've got to find the difference because the lender's not going to pay for it.
Yep.
Then
Yep.
then they will go on to, which was again in the article, which was very honest from the negotiator, because the article came from an estate agent background. So it will be interesting to get an estate agent's feel on this, but then go into the appeals process and a mortgage broker on there saying this is going to increase appeals up massively. Don't tend to agree with that because appeals aren't very common, because they're they rarely get overturned. Rarely.
Mhm. So
If you do,
just to clarify, an appeal in this case is the mortgage customer appealing against the valuation for a
correct.
higher valuation. Yeah.
Correct. They're wanting a higher valuation. Sorry. So let me go back. So you've got, let's use this scenario. You have a property up for sale for 300. They've offered 300. It's only really worth 275. The valuer's come back and said it's worth 275. So the estate agent will turn around and say, "Well, sorry, they're not going to drop their price. You've offered 300. We put it up for 300. It's worth 300." Well, no, it's not, just because you said it is. So they'll then come back with an appeal. We will then go to the lender. They will go for something, if someone hasn't had gone through this before. What will normally happen, and this is, I would say, probably 99% of lenders will do the same process. You will find three properties in and around that area of the same style, size, so same number of bedrooms, same sort of outlook. Because sometimes it's very difficult, but which have been sold. Now that's the key here, not what they've been put up for sale for, because that's irrelevant.
Yeah.
They have to be sold, and most of the time they have to be sold within the last 6 month period. Again, can be very
Mm,
difficult within,
yeah.
if even if you look in a mile radius, it can be very difficult at times. But them's the rules. That's what we have to go with. Um, and then trying to find that, and then go back to the lender. The lender will look and then pass it on to the valuer. The valuer will make their own decision. They come back and say, "Sorry, but no, I don't agree." It's
Mm,
very, very, very rare that they will change their mind, because, of course, if they do, they've got mud on their face, and they don't like
yeah.
doing that. They clearly don't like being wrong, and they want to keep a control of the market. It's the valuers who are keeping control of the market, not the agents. We've had that. If you look back, and we know of 20 plus years ago, when estate agents were putting prices, because the demand was there, they were asking any sort of number for property prices, and people were paying it. Valuers going in and say, "Yeah, it's
Hmm.
fine. If you're wanting to pay as good as gold, stamp next," because
Hmm.
they
Hmm.
were rushed off their feet. Um, now, that's a pretty broad statement, but it was kind of going on, and we all knew that, and everybody's happy because everybody's buying properties, and everybody was getting mortgages, and everybody's making money. So it didn't really
Yep.
matter.
Yep.
Now it's a very different market. So although the appeals process is there, and going on to that, and going on to the article, the one, like I say, the one thing I don't agree with, I don't think, if you have grounds to appeal on a lot of occasions, and trying to find suitable comparables is not, it just doesn't happen. So yes, you've got to be in that position where you do have a down valuation. It's unfortunate. I think we've it's brought to light an issue, which is really, really good. It gets people like us talking about it. But if what I would say is, I mean, to everybody, speak to your broker, get your broker's view, because your broker may turn around, and I'll be quite honest. And I'll do some research on a property, and if I think you're overpaying, I'll tell you you're overpaying. I'm not emotionally involved in this property. I'm not worried. I'm not making any money out of that particular property. It's whatever they want to do and whatever they want to buy. I'd much prefer
Hmm.
my client to buy the proper a property at the correct price, rather than overpaying. And if I think they're overpaying, I'll let them know. And if I don't think the appeals process will work, quite happy to do it. And of course, it's not great for us, because it's just more time. It's more admin. We don't really want to go through it. The lender doesn't want to go through it because it's admin for
Yeah.
them.
Yeah.
The valuer certainly doesn't, because they'll just usually just come back and go, no. Um, but it does bring to light something, and a conversation we certainly had. So, one of those things, it's not going to go away. That's for certain.
So do you think we should just accept and live with down valuations, or do you think the correct answer is really for agents to be valuing at a lower level, and sort of a lot of the properties currently listed should actually be listed a bit lower so that people's offers and expectations are better matched?
Great. That's a brilliant question. Should they be sold at a lower level? No, because everybody wants every single pound and penny out of their property. Once they're told a property is worth 300, they do not want to take 299. And that's the thing at the moment. It's a difficult marketplace, but society dictates that we are still, once we've heard what our property is worth, we don't like to be told that it's worth less. Um,
Hmm.
you know, I see that all the time. So there's a balance there. I think a key sort of message here is, speak to an agent with experience. I see far too often, and we've all seen estate agents. I'm not saying they're bad, but they don't have experience. They haven't seen other markets. They haven't seen markets where people have had to take big hits on properties. They haven't seen negative equity, for example. If you get someone in a local agent who has had a lot of experience, and it's all about gut feeling, really. Thankfully, you don't get the type of estate agents we were having in the property boom of the early 2000s, who were in it to win it, win money and get the next car up or the next mini which they were going to give out, and prizes it being taken to Paris at the end of the month. Those days have gone, thankfully, because it was just sales, sales, sales. And I don't think the service was provided. The people who've stuck it out and they're in and around, lots and lots of them, speak to them all the time. And you get a good feeling with these people. Find those guys. And they're great. They will give you some really, really good advice. And they won't, just for the sake of it, put another 30 grand on your property price just to sell it.
Yeah, so try not to be sucked in by the biggest number available. Instead, look for experience and people you can trust.
100%. 100%.
Sounds good. Okay, so next up then is me blatantly abusing this podcast for a little bit of free consultancy, and I have 3 children, and the oldest of my children is hopefully soon to be starting university, and for the first year, he's going to be in university provided accommodation. But I thought I'd sort of start thinking ahead. And in his second and onwards years, he will probably need private student accommodation of some description. So that got me thinking, rather than paying rent to another private landlord, seeing as I am a private landlord myself, maybe I could help and either buy a house in the appropriate location and he lived there with some friends, sort of as a student household, with them paying rent and him presumably sort of not, or maybe less or something, I don't know. Or maybe it would be possible for this property to be purchased in his name even, but supported by me in some way, shape or form. I mean, at the very least it would be a deposit because he hasn't got any money. But beyond that, perhaps as well in terms of helping with the mortgage. And basically this sort of segment is me saying, what's possible? I don't know. So what might be feasible in this kind of area, Simon?
Well, there are a number of options and a number of ways you can look at this. Second home is one option people then use. So, and then you just have your son, daughter living in the property. They then rent out rooms on to friends and whatever you have at that particular property. That will then be assessed on an affordability basis purely on your income. So can you afford your residential mortgage? Can you afford this second home as well? Now, as we know, people of our age group I have a daughter in second year uni. So we've got quite a lot of expenses and big mortgages outside potentially. So having that then, and university towns are usually quite expensive to live in because they want to be right in the middle of town.
Yep.
So you have that. So it's going to be potentially quite a big mortgage on the top. But are you going to meet that affordability? Yes, some people can. So that is certainly an option. And if you go down that route, the interest rates are likely to be cheaper. What I would say, again, classic, my caveat I use all the time, speak to your broker, make sure you meet the criteria, make sure they're able to let rooms out to friends, etc. Most of the big lenders, you'll be able to do that. So it shouldn't be too much of an issue there, because it is a class as a second home. And you're in it all the time. Now, there are specific products on the market for university students. Okay, so they can get their name on the mortgage. It goes along with your name, and it's assessed on the rental income rather than, much like a buy-to-let, rather than your affordability. You can with some lenders. Now, I'll put something in here. There are very, very, very few lenders who look at this particular product. On the market at the moment, I'm seeing 2. So
Yeah, that's
it's
a
not
small
big.
small number
It's
of options.
Yeah, they're not big. You're looking at rates at sort of 5.5, 5.75, something of that around that sort of
Mm-hmm.
nature. But it does enable you to buy a property in the area, assess it on rental. You can do something called top slicing. So if the rental doesn't actually stack up, you can use your own income to increase that up. So you can get up to sort of the 75% loan to value if you wanted to. You're allowed to have three additional occupants in there if you want to. It can't be, you can't buy an HMO, you can't buy a particular student let. It has to be a house and then to a standard
Mm-hmm.
house. And there are minimum maximums depending on the lender. The maximum sort of loan size is a 500,000. It'd be quite a nice house for a student up at that level. Um,
Yeah, I don't think we're going that big.
Absolutely. But again, it does depend on area, doesn't it? I mean, you have
Mm-hmm.
some areas in the country, if people are looking to buy in central London, um, then it's going to be, you've got transport issues then. So you want to be really close to the college, which means it's
Yeah,
really expensive.
yeah.
Um, so
Thankfully, in my
you,
personal case, he's not. But,
no,
but yes.
absolutely. No, thankfully, my daughter isn't either. But you do have those options there where you want to go. I know people have looked at it doing, and clients of mine have looked at it and going, right, I can just get a standard buy to let. Right, okay. Very, very careful on that point because you may not meet criteria. It's unlikely you're meeting criteria because you have a family member going
Mm,
in and renting the property, which has its own issues with lenders. They generally don't like it. They generally don't allow it. They then
yeah,
don't. You then have four people renting the property, so it will have to be an HMO or a student let. So you're going into the realms of you're looking at a student let property. You've got regulation, you've got licensing. You can't then look at a standard property. You're looking at an HMO or a student let property, so that can be
yeah.
a little bit tricky if you're looking at that. It really does depend on what you're looking to buy, what type of property you're looking to buy. So if it is you just want, I just want a little house, a couple of friends can go and live around. Shouldn't a uni buy to let is probably the way to go, but the rates are a little higher.
Mm, mm.
That certainly, but it's certainly more popular. It's just people tend to get put off because there are very, very few lenders who will look at it.
For those lenders that will offer this, where it's purchased in kind of joint names, presumably because the child would be on the ownership and they will be living there, then the the other tenants would just be lodgers. I mean, I'm not asking you to comment on the legality of that, but do you know if the mortgage brokers are happy with that sort of setup rather than it being a full AST type setup?
Yes, absolutely. They're classed as lodges anyway. I mean, that may be just semantics, really, but it's so they understand that they may not have tenancy agreements. I would highly recommend that tenancy agreements, ASTs, are put in place anyway, even if you are just in lodgings. But I mean, unlike others, my daughter's in second year in a house exactly like this, and they've all got their own agreement with that anyway. They're all got locked doors, but it's obviously because they're meeting licenses. Now, if you're just looking to buy a house, you're not necessarily going to have locked doors. You're not going to have the sort of
Yeah,
same regulations. So it's a way
yeah,
of getting around
exactly.
that. But yes, on that side of things for the uni buy to let, then yeah, no problem at all. You can have up to three lodges. It's really not an issue. So I think it certainly fits. If you don't mind, the thing definitely which seems to put people off is the rate,
Mm-hmm.
and that's it because the lenders don't have a huge amount of competition. I would guess. I know how cynical they can be, so they would just put the rate up. So which is a little bit annoying because I think it could be a little bit more positive. Certainly, if you can make the figures work, and like I say, if it's not in central London, if it's not in central Manchester, Liverpool, etc. I mean, generally, and again, this is a little caveat in there. You it For one of the lenders, the main lender we use, the property has to be within 10 miles of the university. I doubt that
That's
opens it
quite a long
up.
way.
Yeah, yeah. I can't imagine. There's no way my daughter would be going 10 miles out. She doesn't like going 1 mile out from the university. So, and that's generally
Yeah.
how they are. So, that's kind of where we're going with that.
Yeah. So for the just to double check this, the for the specialist products where the child would be on the ownership of the property as well, and the parent is sort of supporting that, does the property have to be jointly owned? As in, does the parent have to be on the ownership deeds as well, or can it just be owned by the child, but with financial support from the parents?
It depends on the lender. Now, one of the other lenders will do it on and I think we've touched on it before, joint borrower sole proprietor, which
Mm-hmm.
what I call a modern day guarantor mortgage,
Mm-hmm.
where you go on there or we go on there as parents, because we have the income and the money to prove it, but we don't want to go on the deeds for stamp duty issues, for issues going on further down the line, and then it's then just the child's property. So depending on how you want to look at it and how you want it to for future proofing, really depends on where the lender goes.
Mm-hmm.
You could, I mean, I definitely like that option, because it's in the child's name. You haven't got any issues going further down the line. Yes, you're still a guarantor. Yes, your name's still on the mortgage. So if it's not being paid, you are liable. It goes on your credit as well. That's a big point. So it has to be paid on time. It's like any other mortgage. You don't want to go in default. But
Yeah,
obviously,
yeah.
future proofing, I think it's a great idea. It's certainly an option you need to be looking at.
Fantastic, cool. Some excellent food for thought there, I think. But the overriding message is the options do exist, but some of them are very specialist, and hence talk to a mortgage broker, such as Simon.
Absolutely, very happy
his
to.
his details are in the show notes. Now, our last segment for today, as we always have, it's a quick fire roundup of the current mortgage market and actual real rates that are available today. No guarantee they will be available when you're listening to this, but they were available today. so Simon, where are we looking? We normally start with simple residential sort of personal home rates. So what's the market like there?
Absolutely. Pretty dull. I'm going to be pretty dull today. I'm going to be. I don't often get called dull, but I'm going to be pretty dull today. Rates have really not changed very much. They were dipping below the 4% mark. At the moment, you're looking at 2-year rates of about just over 4.03. 5-year rates of about 4.1. So they're fairly similar. The good news is, I think, certainly from a borrower's point of view, is that 5-year rates are going up above the 2-year rates. We get that's becoming a little bit more norm now, because it was completely skewed, which we hadn't seen previously. So, is it a good idea? I mean, the burning question I'm getting asked, and we are as a team at the moment: should I go 2 years? Should I go 3 years? Should I go 5-year? The 3-year rates generally are not. We don't talk about them on here very often because they're just
Mm-hmm.
not very attractive, or they're generally not very attractive. It's usually one or the other. It's usually 2-year. It's usually 5-year. I mean, but certainly have a look at them. But um, at the moment, we're still steering slightly over to the side of a 2-year rate, because the feeling is they're still going to be coming down over that period. Whether they do, we've been burnt. Our fingers have been burnt many a time on this pod to know exactly where it's going. So you've got to sort of go with what your plans are, where you're going forward. Um, the There's some good, more exciting, even up at 90%. So you're purchasing at 90%. 5-year rate is 4.39. The differential between the two is really, really good, I think. I mean, if you're
Yeah.
getting up there, that used to be really big, the difference between that. And it's crushing if you're at 75% and there's an onward purchase. But if you've got 10% put down for a first time buyer, which is what the market needs desperately. We desperately need first time buyers coming into the market. That is my belief will kickstart the whole thing. But that's positive. I think that's really good money for a first time buyer coming into the market at 439. Now,
Yeah.
here's
Yeah.
the burning one. Here's the good one. I've got a real corker for you. Buy to let, standard buy to let. The lowest on the market I can find as of today is 1.79%. Yes,
What?
1. I said it. I did. You didn't mishear me.
No, no, there must be a typo in that.
There isn't one. However, we've got a cracking 9.99% arrangement fee.
Oh, it's one of those again.
They really are. They do make us smile, don't they? That's it. That's a 2-year fix. 2-year
Dear.
fix at 179 with a 9.99% arrangement fee. I'm dying to find out how many of these they're doing. I'm sure I will. I will promise to get everybody the information on that at some point. I haven't found anybody it's actually working for.
No, no.
It really isn't. We don't, and again, going back on a more serious note, we're not really finding people buying in a sole name, joint name anymore.
No, no.
It just doesn't happen. Even if you're buying you're a first time landlord. At the moment, as we speak, it's still we're being told by all the accountants, tax advisors, buying a limited company name. And if you go in a limited company name, you can still get that 1.79 rate with a 9.99% fee.
Woohoo!
Not recommended it too soon. But the kind of rates we're looking at in a limited company buy-to-let range, 4.94 for 2-year, 5.12. So around about the 5% mark, you're looking
Yeah.
with either £1,000, £1,500 fee, somewhere around there. So I think, again, that's definitely come down. That's more attractive. Buy-to-let lenders are looking out. They're wanting the buy-to-let business. They certainly want it in the limited company area. It's slightly above that on the HMO. There is a 5.69 5-year rate for an HMO with no fee, 4.34 2-year rate with 3% fee. So they're out there. They're trying to be more aggressive. If I look at that from sort of 4 months ago, it's slightly better from where we are. Certainly from the sort of limited company range. So the residential range, we can see we're going over it. It's not really changed very much. We're being told constantly, we want your business. We want your business. We want your business. I think the only way, we're doing a lot of remortgage business at the moment, obviously, because the buying market is not really there. And until we sort out the first time buyer market, in my view, or the buy to let market, if we get a few breaks as investors, which we're just killing, the amount of landlords, portfolio landlords, accidental landlords, whoever out there, are selling off properties just bit, but not. It hasn't been the big, get rid.
Yeah.
But they're definitely selling,
Yeah.
and that needs to change.
Yes, yes. It's sort of drip, 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 and then suddenly you wake up and, oh my goodness, there's no rental properties left.
Yeah, absolutely. Yeah. And then the rentals are increasing massively, or there are no rental properties, and people who are renting can literally rent the same day. That tells a story, doesn't it? I think which let's talk about that in another time. But that definitely tells a story about what's happening in the marketplace.
Yep. Yes, indeed. All right. Well, I think we're all finished for today. I think the message overall is one of stability, really, which is probably good, if not very exciting. Thank you very much for indulging me, Simon, and on the university accommodation discussion. And for everyone listening who would like to get in touch with a mortgage broker, and specifically Simon Glastonbury, his details will be in the show notes, and he will very much welcome a conversation. thank you very much for sharing all your expertise, Simon. And thank you very much for everyone listening. And I look forward to speaking to you again next time.
Look forward to it.